For more on rates, markets, and the economy ahead of the Fed's policy meeting next week, let's bring in David Zervos, Chief Market Strategist at Jefferies, CNBC contributor. David, looking at Fed funds this morning?
Yeah.
Got about 41 basis points of cuts built in this year, which you can translate into English is a cut plus a debate about another cut. Does that feel right to you?
I think that's a safe place for the market.
Right,
I'm going to shade it a little bit more, but
dovish.
I think
well, what's a little bit more? Give me what a little bit more is.
You know, I think you can make pretty cogent arguments for a lower neutral rate. I know that's a very controversial debate topic, but I think as the Fed morphs in the next few months, we're going to see that debate pick up, Steve. I think there's.
What are you looking for that would tell you that that's what the Fed ought to be doing?
I'm listening to the candidates. We're seeing my good friend Rick Rieder kind of rise up.
Why
in the ranks.
is Rick up there? What's? I get these emails from.
I'm just so excited
is this
about
Rieder thing for real? I don't know.
Why would Rick Rieder want to take such a pay cut?
He's got a great job.
He's got a good job.
I mean, I'm sure he's doing just fine financially.
But you know what?
What does a Fed chief pay?
We need a shirt. Everybody likes Rick. Nobody doesn't like Rick. I think that's one thing.
Guy, yeah.
But he's up there. I looked this morning. He's like in the 30s now.
Almost, yeah. I saw him almost pushing to the 40s.
It was like 45, 35. I don't know if you guys got the Kalshi in the back. But is it real?
You know, I think,
know the administration better than anybody.
I think a lot of dynamics changed in the last few weeks. The sort of desire to keep Kevin Hassett closer to the president, maybe some of the independence questions that started to play with the administration after
45-35, right there. There you go.
After the U.S. attorney, basically after the lawsuit.
Right.
So I think, Rick's a very balanced, fun, and insightful guy. I think he would make an incredible Fed chair.
All right, close your eyes, Dave.
Really quick before we get there. Bond market have a vote in this? Is that what's playing out here when you look at this?
Maybe a little bit. I mean, we've seen the sort of Kevin Warsh float, and the market kind of dipped
couple
back
basis
off
points.
A little bit.
Yeah,
it wasn't big.
Wasn't
Again,
big.
I think these are a lot of nuances. They're not huge differences, but I do think the market would really applaud a Rick Rieder.
Can you close your eyes and imagine the moment when President Donald Trump steps to the podium and says, "My next Fed chair, Rick Rieder"? You can imagine that moment?
I can. Yeah.
Okay.
I think
he's a market guy. The market's got to love it.
I think the market would like it.
We are concerned in the markets. That's an exciting change of pace. It gets us away from the academics that are, focusing on the Phillips curves and their models, and inflation's going to go here because my model says this and that, and we kind of know that's all a bunch of gobbledygook. So
I want to get to something.
It's nice to see guys that really just focus on what we focus on every day, which is what the markets are telling you.
I want to get to something that's really important about the whole Fed debate, which is this notion that the Fed ought to be right now incorporating administration supply-side policy and incorporating the notion of a productivity boom and lowering rates now in anticipation of that, when there's almost no history of the Fed doing that, and the people on the other side of the debate say, let's wait to see the whites of the eyes of this better world that you're talking about.
Let me just say, to call that the administration supply side policy is a stretch, Steve. Supply side is supply side. There's no administration or no administration. And the reality is there is a huge supply side boom. That is what describes
I'm just saying from their policies
here.
Is what I would meant by that. That's their policy.
This is really a debate that centers on traditional Keynesian economics, that you're going to have the folks like Peter Orszag and Adam Posen writing articles about why inflation is going to surge because of all of their traditional Keynesian models, and a bunch of folks who are looking through a Greenspan-esque type lens and saying, hey, this is a productivity surge. This is the 90s resurfacing and telling us something very different. We're seeing strong growth, incredibly strong growth, with very tame labor market moves. In fact, the labor market, by many measures, is pretty weak. We've seen the unemployment rate rise over the last 3 years.
But you guys
by a full
want
percentage point.
You want Greenspan 96. You don't want Greenspan 99. Remember what he did at the end of that process was he prospectively kept rates the same. By the way, he didn't cut. And I guess I'm giving you the Keynesian finger right here.
He stopped the
doves who were liberal, right? But then in '99, he hiked rates in the face of the big boom, which is, I don't know, are we more 96 or more 99 now?
I think we're certainly, I would argue we're more of a 96, but I would say there's also a lot of differences. The labor market wasn't as weak back then either. This is a different kind of productivity boom. What we're seeing in AI and what we're seeing in this technology story is a path of creative destruction that's really rippling through our labor market. It's most felt by the youngest and the most vulnerable, and I think that is a different story than the 90s. So to me, this has a lot of sort of feedback, quite potentially negative feedback into labor markets that we're witnessing. And the more we're just making 20, 30, 40,000 jobs a month, the more we're revising away a million and a half jobs that we thought were created, the more that we're seeing growth at 3%
David,
and the unemployment rate going up.
What if it turns out AI is a fraud?
Well, look, there will be, of course, parts of it that are, because every time
the large language models
technological
are hard to learn because you can't get the nuance of human beings. Ken Griffin said it in Davos a couple days ago, that human beings are not currently being replaced by AI. In fact, I'm summarizing Ken Griffin, because it's missing the nuance in certain parts of language. What if all that spending, all the OpenAI, Sam Altman, what if all that stuff doesn't come to the fruition that the market's
I don't know that the productivity story is all about AI. I could make an argument, Brian, that a lot of this started way back in COVID when businesses said, hey, we got to start doing things with less people because we don't have people. And they really motored through that in many ways, and they changed the way they do business.
David, think about this for the next time we talk, because I'm going to call you.
Okay.
Will Fed rate cuts solve the problem of job loss from productivity?
Absolutely. We will stimulate interest rate sensitive sectors like construction, like housing, like the consumer sector. And we will...
The ones without the productivity.
Well, exactly. And you know what? We don't need the extra productivity.
And the ones where they need jobs. Especially when
so we're taking coders and we're going to make them build houses? Is that what's going to happen?
I mean, we could also have them in financial services. We could have them in other places. We could have them in so many different jobs that would be stimulated via a lower rate structure. You know, if there is a side effect of the positive supply side shock of productivity that is creating a negative demand shock, then your Keynesians would tell you, Steve, you got to stimulate that aggregate demand a little bit.